Yes. Okay, I'm going to get started, and I apologize in advance for what is likely to be a little bit of a scratchy / maybe lose my voice class. I know we're about half full thanks to Snowmageddon, but the recording is going for those that actually will watch. And I appreciate you all coming in this morning. The next couple of weeks, we're going to be focused on taking some of the theory that we learned around present value, future value, and translating that into some real world stuff, stocks and bonds, corporate debt, and other things that sort of beginning to take from the theory kind of into practice and look at theoretical values for things like stocks, for bonds, for preferred stock, cost of, and really starting to build to the value of the firm. When you look at, so we're going to start with debt because debt is the easiest piece to actually value. And it's the one that tends to be driven by a series of payments and interest rates, and things tend to be stated. So before we can really dive into how debt works, we really need to talk a little bit about what debt is and some of the terminology and characteristics we're going to find when we talk about corporate debt. And again, when we talk in here, generally, unless I tell you otherwise, we're looking at corporate debt, generally publicly traded corporate debt. And again, just like stocks, bonds, corporate bonds are often traded on bond exchanges. And so you can buy and sell these things just like you can stocks. And we're going to talk a little bit about what those exchanges look like and how bonds are priced on the exchange. But for the purposes of today, most of what we're going to discuss is going to be within that framework of public bonds or publicly placed bonds, as opposed to privately placed bonds like you see here at the university. So there's a few characteristics or definitions that I want to cover off, because you're going to hear some of this as we go through the next couple of weeks, actually, as we go through the rest of the semester. You've heard some of it already, and I tend to use terms interchangeably, and I'm trying to be consistent with the book, but 20-some years of doing this, I've kind of developed my own pet terminology for things. And so if you run into where I start using pet terminology, feel free to ask, because otherwise it may get pretty confusing. These are all generally the same thing. Principal value, when you look at a bond, bonds are generally priced in terms of thousands of dollars. Normally, a publicly traded bond is a $1,000 block. And that's the principal value. That's how much money is supposed to be paid back at the time of which the bond matures. So you'll see that it's principal value or face value. Again, it says $1,000 is owed to the bearer of the bond or the person to whom the bond is registered. And so that's what's on the face of the bond, the literal bond document. The maturity value, that's the same thing.
when the bond pays off, at the end, you'll get that $1,000. In between, as we're going to see, that price can vary. But when you talk about maturity value at the end, it's going to be generally that $1,000 and par value. You're going to hear par value in terms of bonds. I try not to use it often when I'm talking about bonds because there's par value in stock and the two tend to get confusing. Especially when we learn about par value in stock, you realize it really doesn't mean a whole heck of a lot. So you will hear or see sometimes par value as it pertains to bonds. And what par value is, as it pertains to any security, is the stated value of that security. This is essentially what the obligation is of the corporation to make a payment. Par value stock is essentially the minimum value of the stock. Par value of a bond is the maturity value or the face value or the principal value of the bond. Any questions on that concept? Interest payments. Interest payments are the periodic payments on a bond. Some bonds have zero coupon, and zero coupon, when you hear coupon, that means payment. Back in the dark ages, and we're talking before my time, which is really dark ages, back in the 70s, 60s, and even earlier, bonds literally had coupons. So you'd have a bond at the top, and it would say $1,000, and then underneath it would be a little coupon. It was about this big, and I've seen such things when I worked at a bank, because folks would take these bonds and stick them in their safe deposit box. And then they come in, these little old ladies would come in with their keys, and they open up their safe deposit box, they take out the bond, and they literally take scissors and cut the coupon off the bottom of the bond. And so you'll hear sometimes clipping coupons. Clipping coupons as it pertains to bonds isn't clipping coupons out of the newspaper. It's literally going to your little safe deposit box, cutting the coupon off the bond, which says the bearer of this coupon is entitled to an interest payment. Then they would take that coupon and they would walk over to the bond desk and they would hand it to the person at the bond desk would give them money minus a processing fee. So you'll see interest payments or coupon payments on a bond are just the periodic payments that are made from the time the bond is issued until the time the bond matures. You'll see it listed as interest payments usually in the book because such things are now generally no coupons attached. They just automatically pay to the registered holder of the bond. However, you will also see coupon payment. You will also see a term called zero coupon bonds, which means bonds that pay no interest periodically. They're issued at a discount, issued at a discount, and then the principal value is paid at maturity. Question? Okay. Maturity date. Who wants to posit a guess what maturity date is? Yes, sir. Yeah, it's when the principal amount of the bond needs to be paid to the holder. So the maturity date is going to be at some point in the future usually, and the interest payments are paid between the issue date, which is the date the bond is actually issued, and the maturity date, the date the bond matures, and the maturity value has to be paid. Bonds have a priority to assets and earnings in the event the company doesn't do well. And so you've got, I'm not going to dive deep into bankruptcy law. That's my past. So I'm going to try to summarize it as easily as possible. If you've got a bond or you're a debt holder, you get paid before common shareholders get paid. You get paid before preferred shareholders get paid. There's only a few folks who get paid in front of bondholders. Those are employees and some trade payables, some of the most recent debt incurred. So you got a priority if the company goes into liquidation or if the company files for bankruptcy. If you own a bond, you get paid in full before any stockholders get paid. You get paid in full before any preferred stockholders get paid. And then within the bonds, there's normally a ranking of, senior secured all the way down to subordinated debenture. And we'll talk a little bit about that in the course, where within the bonds, there's a priority of who gets paid. And it's what you'll hear me sometimes term a waterfall. where the top person gets paid in full, then anything left over cascades down to the next pool, and that pool gets paid in full, and then anything left over cascades down to the next pool, and nobody gets paid down the waterfall until the people above them are paid in full. So debt has priority to assets and earnings over preferred stock and common stock. What debt does not have, however, is control. So once you've got voting rights, you become really an equity holder. And so what you won't see is someone who's got a bond can't tell the company what to do. They can only tell the company, you need to pay me back. I loan you money, you pay me back. There may be covenants around the bond, which requires the company perform in a certain way, otherwise the bond goes into default and the bondholder can demand immediate repayment. But in general, there's no voting rights that come with bonds. So if you're a bondholder, all you're looking for is your interest payments and your principal getting paid back. And you can't control whether the company, who's on the board of directors, you can't control whether the company's going to merge within some semblance of reason. There's case law on that. If the company merges and it's designed to make your position be worse. But in general, you have no control. Any questions on these 5 characteristics of debt before we start diving into bonds specifically? Okay. We're going to dive into the different types of debt. We're going to talk government debt, corporate debt. From a finance perspective, they all are valued similarly in that the value of any financial asset is a function of the expected future cash flows discounted at an interest rate. That interest rate is reflective of the underlying or inherent risk in those cash flows. Yes, I will get it in every class. So we'll start with treasury bills. Treasury bills are issued by the U.S. government. They're generally very short term in duration, 90 days or so. They're used to finance day-to-day operations of the government, essentially the immediate liquidity needs of the U.S. government. And it says they're discounted securities. Who wants to tell me, or who can tell me what a discounted security is? You're on the right track, yes, sir.
This is treasury bill, right?
Yeah, T-bills, yep.
This is the one that they buy back from themselves so they can do something more, right?
All kinds of sort of.
They can use it to make money.
I'll get into monetary policy a little bit. But what's discounted securities? Leslie's on the right track. Yes, sir. Yes. So for a treasury bill, you'll see these things generally put in terms of 98.75, which means the government issues them, and treasury bills are issued in blocks of 10,000, not 1,000. So you'll see at 98.75 is the price when they issue them, which means essentially the federal government is going, okay, you give me $9,875 today, and in 90 days I'll pay you back $10,000. At current interest rates, the federal government is saying, I will issue you, or you pay me $9,975 or so, $9,945, and I will pay you back $10,000 in 90 days. They're issued at a discount, so there's no interest payments made. They're essentially a zero coupon bond that is issued at a price below the par value or below the maturity value, and then the difference is the interest payment. And there's very little risk that those are going to default. There's very little interest rate risk. There's very little liquidity risk. So there's very little default risk, liquidity risk, maturity risk. And so as a result, what you tend to see is very low interest rates on treasury bills. There's a high liquidity because there's short maturity, and there's a very, very robust market to trade. A repurchase agreement is similar, and it's for corporates. So where treasury bills are issued by the government, repo agreements or repurchase agreements are issued by corporates and from banks, and essentially they sell a bond at a lower price with an agreement to repurchase that bond normally 24 hours to 48 hours later, and you'll hear the term overnight repurchase agreement, at a higher price later. These are extremely safe assets, generally, because you have no liquidity risk, low default risk, you have low maturity risk, or almost no maturity risk. When you look at, if any of you have a money market mutual fund, you'll tend to see that the money market mutual fund is full of repurchase agreements. Essentially, the money market mutual fund that you may or your parents may invest in and have your money parked in generally has their assets in overnight repurchase agreements or short-term repurchase agreements that are laddered or set up so that they mature. A chunk of it matures every day, gets reinvested every day, which provides high liquidity and a little bit higher interest rate than if they stuck it in a CD where you can't get the money out until the CD matures. Fed funds, or the federal funds, are loans made through the Federal Reserve at a set interest rate from one bank to another. When you take BA 311, when you take money in banking, you're going to dive into Fed funds rates and why it's important and what banks have to have on deposit and what the reserve ratios that required reserves are. But what this does is essentially allows banks to meet reserve requirements and continue to lend money. And they borrow from each other. So a bank may have surplus for a day, another bank may be short for a day, and the Federal Reserve facilitates a loan between the two at a very low interest rate. You can see the Fed funds rate is set by the Federal Reserve. You can look it up. And it's one of the ways that they hold monetary policy and try and keep the monetary, the level or supply of money up or down is by changing the Fed funds rate. Because it either provides an incentive for banks to have surplus and to loan the money in, or it provides an incentive for banks not to have surplus and to loan the money, either to loan money to other banks or to loan money to their customers. So Fed funds tends to be one of the, it's an overnight rate, and it tends to be one that the Federal Reserve uses for monetary policy purposes. You can go out and buy treasury bills, and you can invest in repurchase agreements normally in a mutual fund. You can't invest in Fed funds rates. If you're in banking, you'll deal with Fed funds. If you're an individual investor or in a corporate world, Fed funds will impact your bank's lending rates, but you can't participate in that market. A few other short terms. Banker's acceptance. I put down there, it's a post-dated check. Essentially, the bank says, if you have a banker's acceptance, it says, you can come in and cash this, or come in and redeem this banker's acceptance in 3 days, 5 days, 30 days, 60 days. Short term, it's basically a short-term obligation that the bank said that they're going to be able to honor. Commercial paper. Commercial paper is the other component that you tend to see in money market mutual funds. It's a promissory note, IOU, issued by financially sound firms where repurchase agreements tend to be 24, 48 hours in length. Commercial paper may be 60 to 90 days in length. And where you're going to use commercial paper, if you're an investor, it tends to be short-term liquidity. If you're a firm, you're going to tend to use commercial paper to provide your firm with short-term liquidity needs because the interest rate is low. So if you think about when you need to borrow, and you think about the components of risk, you've got liquidity risk, and you've got maturity risk, and you've got default risk. when you look at going, okay, I need $100,000 or $200,000 that I need to have steady all the time in my bank account. If you borrow that long term, you may be paying 3, 4, 5% on that money because you got all three of those components of risk associated with that bond. But if you're going, okay, I know I need this money and the market's solid, I can take maturity risk out and I can reduce liquidity risk and I can reduce default risk by using commercial paper. So financially sound firms, one where default is relatively low, the chance for default is relatively low, and they know they're going to be able to roll, is the term roll that paper, and every 90 days refinance it. They'll use commercial paper because the interest rates are lower, because you've taken some of that risk, maturity risk, default risk off the table. That make sense? CDs, certificates of deposit, are essentially commercial paper or short-term time deposits that are liabilities of the bank. You're loaning the bank money when you buy or when you invest or when you put money in a certificate of deposit. So a CD is with a bank or other financial intermediary, and you need to think about, as a consumer or as a business, when you put money in a bank, you're loaning the bank money. We talked about this earlier in the semester. You loan the bank money. They pay you a small interest amount. They take that money and do what with it? They lend it to other people at a higher interest rate than what they're paying you and make money on a spread. And so a certificate of deposit is essentially you loaning money to a bank, the bank aggregating those loans, making loans to other folks, and making money on the spread. Eurodollar deposits are deposits at a bank outside the U.S. that isn't converted to the local currency. So if you have a dollar-denominated deposit in a bank in Switzerland, it's a Eurodollar deposit. If you have a if you have a Swiss franc denominated deposit in Switzerland, it's a foreign deposit. So Eurodollar deposits are deposits in foreign banks outside the U.S., but still denominated in dollars. Money market mutual funds, we talked about this. The pooled funds that are invested in money market instruments managed by investment companies. Those money market instruments are what? We talked about. Repurchase agreements and commercial paper. So you tend to have, there tends to be 4 pieces in a money market mutual fund. Most money market mutual funds are invested in corporates. On the corporate side, you tend to have 2 large pools. You've got overnight repurchase agreements and you've got commercial paper. You also have in money market mutual funds sometimes treasury bills, and you have certificates of deposit, short-term certificates of deposit. So basically on those last couple slides, you can take all those, push them together, create a mutual fund that has high liquidity, a lot of diversity in the assets, and it provides you with decent investment returns. And so that's what a money market mutual fund is. They're generally managed by companies like Vanguard. You've heard of some of these companies, I'm sure. Your Vanguards, your Goldman Sachs's, and you guys can invest in them with amounts as low as $1,000 up to the millions of dollars. And mutual funds, and we'll talk mutual funds more, are essentially they aggregate both securities on one side and investors on the other, and say, okay, there's a pool of securities that we're going to offer to a group of investors. You could not get the diversity. There may be 2,000 different repurchase agreements, certificates of deposit, treasury bills, and corporate commercial paper pieces within that mutual fund. You as an individual could not have that diversity because you couldn't buy all that stuff. You don't have enough money. But in a money market mutual fund, you own a tiny fraction of that pool, and you get the diversity without having to go buy each of those individual components yourself. And the investment company takes a management fee to be able to do that for you. Any questions on short-term debt? Those are the big chunky pieces of short-term debt. Now we'll get to the big chunky pieces of long-term debt. Term loans. Term loans are, if you think about it, and I'll now shift into personal stuff because it's easier to kind of relate to. When you look at term loans, give me an example of a term loan that you might have. Car payment. What else? House payment. What else? Student loans. You're not paying on those yet, for most of you, but those are all term loans. Essentially, a term loan is obtained from a financial institution, a bank or other financial institution. You make a series of payments consisting of interest and principal over a series of dates. So you're normally in a term loan, your payment is fixed. So if you got a $10,000 car loan over 5 years, your payment might be $210 a month, and you make that $210 a month over 5 years, 60 months, and that's a term loan. It's for a term of time, a fixed amount, and usually a fixed interest rate and a fixed payment. Then you've got a bond. If you look at these two definitions, what's the general difference? Because corporations have term loans too, and corporations have bonds. What's the general difference between these two definitions? Perfect. So on a bond, you're normally only making payments of interest during the life of a loan, and then you repay the principal amount at the end. Here, you're making interest and principal payments throughout the life of the loan. Now, for bonds, what's the pros and cons, advantages and disadvantages, when you look at things like payments of interest over the life and then full payment of principal at the end versus a term loan? If you're sitting as a corporate finance manager, where's your advantages and disadvantages between these two? Yeah, money today is worth less in the future, and so therefore this has less cash flow out up front. But what does it create at the end? It creates a long-term bond payable that you're not paying down over time. So at the end of this, with a bond, you've got, in the short run, if you look at these two and you borrow $10,000 in a term loan or $10,000 in a bond, on a bond, you're going to be paying less incrementally. You're going to be paying out just the interest. So if it's at 5%, it's $10,000, you're going to pay $500 a year. And then at the end, you're going to have to come up with $10,000. Here, you're paying it down over time. So you may be paying $10,500 the first year, $10,400 the second year, or $1,500 the first year, $1,400 the second year. Here you've got more cash available to reinvest during the course of holding the bond. But at the end, you have what we affectionately in the trade call a bullet. You've got a bullet repayment. So essentially, you have to come up with the full amount, either in terms of writing a check and paying the principal off, or you have to roll, and we talked about that a few minutes ago as it pertained to corporate commercial paper. You have to roll that into a new bond. You have to refinance it. And if you can't, it comes back and it blows you up because you essentially default on the bond and you go bankrupt. So bonds, you have to repay the principal amount at the end. If you can't roll the bond, and if you can't write the check, you default. Here, you have to come up with more cash over the life, but at the end, you don't have a bullet. You don't have something that's coming at you that's a big number You either need to be able to refinance or they need to be able to pay off right away. So the biggest difference between term loans and bonds are principal payments during the course of the time the term loan's outstanding, no principal payments during the life of a bond generally until you get to the end, and then you have a bullet on the repayment. Any questions on the difference between term loans and bonds? You'll see both in the class. These tend to be traded on the market. You can buy bonds. Banks will trade term loans amongst themselves, but you can't go out and there's no term loan exchange for you to go buy term loans generally. Bonds, you can go buy and sell. Here's a few typical bonds that are out in the market that you can buy. Government bonds, there's two different kinds. Munis, or municipal bonds, they're issued by state and local governments, and treasury bonds are issued by the U.S. Treasury. Anybody have an idea what makes municipal bonds attractive to investors? There's security with the government, because how do these get repaid? Taxes. Normally, state and local governments cannot run budget deficits. Under almost any circumstance, the state or local government cannot run a budget deficit. And so as a result, if they need more money, what do? They raise taxes or cut spending or both. So municipal bonds are fairly good. We've got a couple instances of municipal bonds not being so good because municipalities can file bankruptcy too. They can file Chapter 9, which is a municipal bankruptcy. City of Detroit filed Chapter 9 and defaulted on their bonds. Orange County, California filed Chapter 9 and defaulted on their bonds because they couldn't raise taxes enough. Or in the case of Detroit, the tax base eroded. And so you had a combination of eroding tax base, decreasing population, and you started seeing increasing bond requirements driven by long-term pension obligations of the city. And eventually it couldn't fund itself and it collapsed. So municipal bonds aren't default risk free. And you need to analyze and understand that if you're going to be a municipal bond trader, that they can default, they do default, and cities and counties and states, well, states can't, cities and counties can file bankruptcy. States cannot file for bankruptcy. So Puerto Rico had to get a special permission from Congress to file for the equivalent of bankruptcy this last summer. And Puerto Rico's in the same boat, they've defaulted on their municipal bonds. What's the other attraction to a municipal bond? Well, we guaranteed with the caveats I just gave. The interest on municipal bonds is federally tax-free. So it allows states and local governments to borrow money cheaper because the interest amounts on those bonds are federally tax-free. You don't have to pay federal tax on it. And if you're in that state, you don't have to pay state tax either. So if you're a New York State resident and you own municipal bonds from the state or the city of New York, you not only get the interest federally tax-free, you get it state tax-free as well. So that allows folks to do it. We're gonna kind of look at the math behind this in next class, I think, based on the speed at which we're going. You're gonna see that allows the interest rate to be lower. In some cases, municipal bond rates can be 40 to 50% lower than equivalent corporate bond rates because of the tax shield. The value of that tax shield has decreased a little bit due to the new Tax Reform Act because corporate rates or marginal rates went from 35% to 21%. That reduces the value of that tax shield. But municipal bonds are the interest, there's tax-free for both federal and state purposes. Treasury bonds are issued by the U.S. Treasury. Can the U.S. Treasury and the U.S. government run a deficit? Yes. The U.S. government, unlike state and local governments, can run structural deficits. What backs U.S. Treasury bonds? That's awesome. The full faith and credit of the U.S. government. Can the U.S. government file bankruptcy? No. What happens if the U.S. government runs out of money? They make more. There's the only limitation on the U.S. government's ability to borrow money is this thing called the debt ceiling, which Congress put in place about 20 years ago, and which they continue to increase. It's kind of a joke, actually. But there's a debt ceiling. So U.S. Treasury bonds are limited to issue by Congress to the amount of the debt ceiling, which gets increased every time they use it to like shut down the government and get whatever leverage they want, and they increase the debt ceiling. Because if they don't, we'll default. U.S. government can default, but it can't file bankruptcy. And so if it defaults, they'll just print more money or raise the debt ceiling and continue to function. So Treasury bonds have essentially a zero default risk. They have high liquidity because you can trade them on the market. There's a very robust Treasury market. And so you've got essentially these government bonds where treasuries aren't going to default. Municipal bonds can default, but it's rare. Treasury bonds, interest rates are going to be a little bit higher because you have to pay federal tax on them. Municipal bonds, no federal or state tax paid. And they're both supported by the taxpayer. Corporate bonds are exactly what it sounds like they are. It's a bond issued by a corporation, sometimes traded, sometimes not. And it represents a typical bond. And again, we'll talk about things ranging from senior to subordinated debenture. But it's essentially an obligation of a corporation. And then there's a mortgage bond. Any idea what a mortgage bond is? Because there's two different types. There's a corporate mortgage bond, and then there's a mortgage-backed security.
Isn't that something about when you like take out a mortgage loan and then whoever's your like loan lenders will trade it in the market or something like that?
Okay, so Carissa's on the mortgage-backed security, so we'll talk mortgage-backed security first. There's two different types of mortgage-type securities. The first one that I'll talk about is mortgage-backed security. It's a bond where they take a bunch of individual mortgages. So when you go in and you go buy a house, you go to the bank and you sign a loan, and the bank loans you money. The bank takes all the mortgages that they wrote that month, they bundle them up, and they sell them. And they sell them to another company, which will aggregate a bunch more loans that are similar and create a bond. And they'll sell that bond into the open market, and it's called mortgage-backed security. Essentially, it's a bond that has behind it thousands of individual home mortgages or commercial mortgages. And as a bondholder, you get interest payments and then principal payments. And as the lender, the bank, you get your money back so you can lend it again. Because you're not holding this mortgage for 30 years. You've actually sold the mortgage off. It's been securitized in the form of a mortgage-backed security, and you've got your money back. I'll tell a little story. When I was back in 2008 financial crisis, I was working for a private equity firm, and my assignment was to go to a company called Accredited Home Lenders in San Diego, California, and try and make accredited home lenders live. Accredited home lenders made billions of dollars of loans, mortgage loans, to hundreds of thousands of people on the West Coast. What they did was they had lines of credit that were $4 or $5 billion. So relatively small, may not sound small, but it is for a mortgage company. $4 or $5 billion line of credit. And what they would do is, Carissa would come in and she goes, I want to buy this house, $300,000 house. We'd say, okay, that's fine. We're going to write you a mortgage for $240,000. And we write the mortgage. We take money off the line of credit. We hand $240,000 to the seller, and Carissa would sign a note. We'd stack up all these notes. And then once we got to $1 billion of notes, we'd package that up and we put a mortgage-backed security out into the market. Well, in 2008, what ended up happening, what caused the underlying cause of the 2008 financial crisis, at least from the seat I was in, was that market froze. So I could continue to lend money to Carissa and everybody else in the room, but I could only lend up to $4 billion, and then I had to pay off my lines. I couldn't, the bond market froze. Nobody wanted to buy mortgage-backed securities because they didn't actually believe that Chris's house was worth $300,000. And so they said, I don't believe that that $240,000 is any good, and so I'm not going to buy those loans. The biggest purchasers of those loans and securitization pools were companies like Lehman Brothers, Merrill Lynch. And so when they froze, or when they ran into trouble, they couldn't offload these to individual investors, and the entire market ground to a halt. What ends up happening then is I can't make more mortgages because I'm stuck with $4 billion of these things on my lines. You can't buy more houses, and investors don't want to buy the bonds. And the entire economy, particularly that revolved around mortgages and real estate, collapses. So that was 2008. It was a lot of fun. And it was driven by the fact that these mortgage-backed securities couldn't trade anymore, and everybody locked up. The entire market locked up. The other side of this is a mortgage bond that's issued by a company, and I'll use an example that's near and dear to your hearts. St. Martin's has issued a mortgage bond. So when St. Martin's, several years ago, 2014, borrowed or refinanced its bond issuance, $32 million. That $32 million that St. Martin's borrowed really dates all the way back to, go back far enough, 1991, 1992, and it's rolled forward. The biggest borrowings on that bond issue were to build this building, Harden Hall, to build Parsons Hall, to build Spangler, and it also backstopped or continues to help fund the construction of Sebula Hall, Panowitz Hall, and the Science Building, the new Science Building. It's now about $28 million that the university owes. It issued a mortgage bond. What do you think that mortgage bond is backed by?
20 years.
Well, it's outstanding for 30. But I heard buildings, which, yeah, the buildings. So it's backed by fixed assets. So interestingly, at least to me, the university, all the land that the university sits on is owned by whom? Nope. The monks. St. Martin's Abbey owns all the land, except for a strip of land around Harden Hall, around Parsons Hall, around Spangler, around Panowitz Foundry, around Sebula Hall. 10 feet around each, plus the land underneath it, is owned by the monks but pledged to the bank. So in the event St. Martin's defaults on its bonds and doesn't pay them, the bank can foreclose and take those buildings, and those buildings only. Who do you think is in a better negotiating position if the university defaults on those bonds?
Wait, so he just hit the building?
It just hit the buildings.
So are they just gonna close them down?
Well, we're not going to default on the bonds.
I thought the banks own the land around.
They own the land around the buildings, and they don't own the land, it's pledged. So there's a mortgage on the land underneath the buildings and on the building themselves.
I thought they could build a trench if they want.
So they can build them both.
I didn't know they had the ground under the.
Yeah, that's all, the ground under the buildings and 10 feet around the buildings is being pledged. So the bank, if the university defaults, the bank can foreclose on those buildings and that 10-foot strip of land around the buildings. what that does essentially is nobody ever goes into these things expecting a default. And certainly no one expects us to default now. Having said that, if there is an incidence of default, I like our negotiating position as the CFO better than the bank's negotiating position because they can't get to the buildings. Because they only own a 10-foot strip around them. And, yeah, and the landowner of the building above it. And what are they gonna do with Barnett Hall?
So we're gonna have a break.
Yeah, they won't put a credit union in here, it's US Bank, but. So it's a mortgage bond is a bond secured or backed by specific fixed assets. Universities issue. A mortgage bond is only as good as really the ability to repay and the collateral that it's backed by. And in our particular case, it's backed by those specific buildings. And it would be very difficult for the bank to actually execute a foreclosure and because the bank doesn't want to own buildings, the bank wants money. So if they foreclose, they sell the buildings. And so again, all 300 acres here are owned by the monks. The buildings are owned by the university, except for the St. Raphael Center, the monastery, the Abbey Church. That's the old Lynch building, it got renamed. The Lynch building got renamed to the St. Raphael Center. It's a little tiny building over here that's got the counseling center and the Abbey guest house. That's the university owns buildings, the monks own the land. The monks can kick the university off if we don't do certain things. We've got a license agreement. If we don't do certain things, the monks can kick us off campus. They can take the university back, fire the president, fire the board. The monks can take over.
This is just a month.
Huh?
I don't think it's.
Yeah, I don't. The monks, by the way, do not want to run the university full time. They gave that up in the early 1980s.
Isn't this their college?
It is. So, and I'll leave it with this because I find it interesting because I walked into this and I was like, this is a bizarre governance environment. The Abbey controls the university. The 25 monks that hang out up at St. Martin's Abbey control the university, and they have a license agreement which says we're going to vest that control in the hands of a lay board of trustees, on which the Abbey has 6 seats, and a president that's hired by that board of trustees that does not need to be a monk but needs to be a practicing Catholic, and a bunch of lay people like myself will run the university. There's 2 positions that need to be filled by monks: the chancellor, who's the abbot, and the university treasurer, who's Father B. Classic. And Father B has to sign every check. So every check that goes out of here is actually signed by a monk. And they can fire the monks, the 25 monks can fire the board of trustees, can fire the president, can fire all of us and take over. They won't, because they don't want to. But that's the governance structure. So in the event things go to hell in a handbasket, the monks can fire the president, can fire the board, can fire any board under the president. Yes, sir. No, they get paid. So the monks have to be paid per the license agreement for whatever position they're in, the equivalent of whatever a lay person will get paid. But they don't get paid it personally. So for instance, if you've had Brother Boniface for Spanish, we pay him the same way we would pay any Spanish professor or any world languages professor at that same level of experience, but we give the money to the monastery because the monks have taken a vow of poverty. So they can't own any personal property, or they can't own any personal property outside of small things. And so we pay the monastery that money. Yeah. So
No spending levy?
they have to ask the abbot for spending money. They have no credit cards. Yeah. They have to ask the abbot for spending
I
money.
guess they always wear the same outfit, though. They don't need
Not when they
to
leave campus. When they leave campus, they dress like normal people.
Really?
Uh-huh.
I don't understand.
Any other bizarre questions? Because it's time to go, but I'm happy to answer.
How often do they leave?
I know, I saw Father G leave with some, I don't know, civilian person.
Like, my brother Luke, like, showed us the schedule,
Gives them routine.
and in his schedule, it said, like, go out for drinks with friends or something.
With the
Like,
guys.
the guys, yeah. Go out for drinks with the guys.
What?
You want to, to get one of the most, and if any of you know Brother Allen, Brother Allen, he's the one that sings. He loves going to the Dirty Days for pizza and beer. Monks are normal dudes. They just have a different lifestyle than most of us. All right, I'll see you Friday.
You're being recorded right now?
Oh yeah, we were recorded.